Okay, March 19th, this past week, has been, I think, one of the highest in the time series for volatility in the Treasury market, and I'll show you the chart on the next screen. We'll get through this. Look at this 2-year, week over week, down 79 basis points, so that it is down 60 basis points from the beginning of the year. The high just on March 8th. 5.05%. March 8th, we're talking 11 days ago, 5.05, now sitting at 3.81. That is a huge move in 11 days. We look at the 1 month, down 50 basis points. The 2 month, down 40. And where's our 10-year over here? Down 31 basis points. All of these were the October highs on yield, so it's not as impressive as looking at the 2-year. Now, the 2-year leads the Fed funds rate. We know that. We've already done the regression for that. We've seen that, and the 2-year is indicating that the Fed funds rate has probably peaked and is going lower, especially when you have the 1 month dropping down to 4.31, and we're 3 days ahead of an FOMC meeting. We have a target range of 4.5 to 4.75. There is a probability. The majority of the probability, if you look at the bottom of the screen here, 62% on 25 basis points. I think they're pretty much locked into 25 basis points at this point. But here is the market saying, no, sometime in the next 30 days, you're actually going to get a cut. So there is some thinking of a cut, even though the probabilities don't say that. Now, last week when we looked at the probabilities, we had a 25 to 50. We had a 71% probability of 25 and 28% probability of 50. And I said that sometime during the week we're going to see the weighting move down to the 0. That more and more market participants are going to think, well, the Fed can't possibly continue to increase at this point. I think they can, and I think they will. I think 25 is your move that you're going to get on Wednesday. I would be surprised with the 0, 38% on 0. And if we go out to June, I am jumping ahead here. If we go out to June, this is really impressive. Last week, the weighting was 5.25 to 5.75. This week, those are all zeros. Whereas last week, all this was all zeros. It's all shifted down. You got some weighting now on 4.25 by June. Which has to happen with a rate cut. This is the upper bound, so that is implying 2.1% on 2 rate cuts. That's 50 basis point rate cut. The weight happens to be on the 4.5 to 4.75. So either there's going to be they're on hold from here on in all the way to June, or there's at least one cut. That's where the weight seems to be. Some saying, yeah, there'll be one more rate increase, and that will be it. I think we are looking at a 25 basis point rate increase, and I'll give my logic a little later on. Let's just get through the facts of what we have here. The balance sheet is another interesting one to look at. You have the balance sheet, and on the balance sheet there is the open market operations, the account just for the quantitative easing that was done that is running off. It is still running off. It's down another $9.182 billion. In T-bills, treasuries, and MBS. So sitting at 7.837 trillion, but that really doesn't matter. The balance sheet on net increased by 297 billion. So you had 9 billion of runoff from the SOMA, but the balance sheet has increased 297 billion. We'll have a look at the chart, the balance sheet chart. We'll go to the Federal Reserve and look at it from their site as opposed to from some other site. Slopes. Also, again, another really interesting thing going on here. Look at your capital market inversion, the 2 to the 10. It was 90 basis points. It's now negative 42. You had an increase in steepness of 48 basis points. And we know, looking at history, that curves invert before recessions, but steepen ahead of the recession because the market anticipates the massive rate cutting that's going to happen, and the short end of the curve drops. Remember, I said that these inversions are usually solved by the short end of the curve dropping, not the long end of the curve rising. Well, look what you had on the short end of the curve. The 1 month down 50 basis points, the 2 month down 40, the 2-year down 79, and the 10-year down 31. That is not the tail end increasing. The tail end of the curve, the long end of the curve over here, is dropping. It's just the short end of the curve, the front end, is dropping even faster. That is typically how uninversions correct themselves before a recession, is the shorter end of the curve drops faster than the longer end of the curve, thereby steepening the curve. You've got that underway. So if we're looking for another recession indicator, this is consistent with every recession that we've had, is that the curve inversion solves itself by the front end of the curve dropping rapidly. And that's what we have here. We're now down 42 basis points. So if you were playing curve steepeners, this is the week it hit. And that's the thing with curve steepeners with an inverted yield curve. It will correct itself. They all do. They cannot stay that way. Inverted yield curves don't hang around long. So when you play a curve steepener, it is an inevitability that the curve will steepen. It's just you don't know when. So it's just a game of time. 256 days inverted, and we are heading towards, well, at least from negative towards zero. The capital market to money market inversion, the 3-month to the 10-year, negative 113. It did steepen a bit, 18 basis points, 144 days inverted. And remember, this one here, every inversion has a 100% track record. Everything is consistent with an upcoming recession at this point. And when we look at some other indicators, usually we'd expect to see certain things happen in gold. We'd expect to see certain things happen in key commodities. We would expect to see certain things happen in money market funds. All of them are consistent with the behavior that does in fact induce the speed of the recession. So I don't know that it is avoidable at this point. 18-month, the 3-month, 18 months from now minus the current 3 months, this is a money market to money market inversion, 166 basis points. Last week it was 131, the week before was negative 74. The effective federal funds rate, that's not really going to budge until you actually get a change in the federal funds rate, 4.58. Reverse repo down 82 billion week over week, still over the $2 trillion mark, however, and that was at 4.55% one-day SOFR. These are big moves in a week. I got to tell you that, especially in the Treasury market. So let's have a look at CVol, and then we'll look at the Fed balance sheet. Okay, so here is our volatility. You can see this spike. This is over the last month. You can see this spike in volatility. And you think, well, it doesn't look like much, right? Well, let's just zoom out and have a look at how that looks in context. There's all of 2022. You're going back to the beginning of 2022. Look at that spike in volatility at the end. Let's go back and look at the pandemic. So here's the pandemic. Unfortunately, with this chart, you can't just hover your mouse over it, but you can see the height here and look way over here in terms of where the volatilities are. I'll take my mouse off that chart so that you could just see it. Look at that spike, and that is in a very short period of time. That's a behavioral change. Money doesn't flow into treasuries at that rate and at that speed, only to turn around Monday morning. It doesn't do that. When this much money moves this quickly, it's usually for a period of time. It's usually because a large enough group of people or group of investors have said, okay, let's just get out of the way for a while. They're not doing this just for, okay, oh, Sunday night, everything's okay, let's go back out into the water. No, there's blood in the water. There's sharks out there somewhere. You don't know how many there are below the surface. You've just ran onto the beach. You're not about to say, okay, I don't see any shark fins, let's get back in the water. No. Not when you have a spike this big in volatility. That money is on vacation for a while. Even if we go back a little bit further here, look at that. You can really see that this increase here is 2022, and look at that jump in just 1 week. Where's our Fed balance sheet? So here's the Fed balance sheet. This is going all the way back to 2008. You can really see what the period all the way up to our current period looks like. Just this massive increase. See this little spike on the very end? it doesn't look like much until you zoom in to exactly what it looks like. There it is, 1 week. We were sitting down here, 8.339 trillion, 8.342 trillion, and now 8.639 trillion. And I don't think we're done on that. That is just the Fed's opening up of that 1 year borrowing facility where they will give par. They will treat the collateral at par as opposed to its current value, treating it at par. It's all cash good security, so I don't think that they're too concerned. They can always just bring it onto their balance sheet and continue to hold it. They're not going to lose, but they are now providing liquidity to a system which kind of is starting to work against what they want to do for inflation. So if you had to put yourself in the Fed's position right now, what do you do? And you have to think about it in terms, not what would you do, but what would you do if you were that person? You have to imagine that you are that person. So it's not a matter of, well, my opinion is do this, my opinion is do, oh, they can't raise, oh, they should cut. No. Think that you now have the job and it's your responsibility and history is watching. It will remember you. What do? Do you risk the stability of the financial system by raising rates even more and seeing what else breaks? Because it's all unknown unknowns at this point. What else breaks? And risk inflation becoming unanchored and having a bigger, uglier fight in 6 months from now? Or do you keep your eye on the ball? You did say there was going to be some pain. There has been some pain. You didn't lie about that. Do you raise rates because inflation is the bigger deal? What do? I'll tell you something. It's going to be an interesting meeting, but we all know the real story starts at 2:30. The release of whatever they're going to do is meaningless. It all starts at 2:30 because there has never been anybody who performs in press conferences the way Powell does. You don't know what you're going to get. Are you going to get Volcker Powell? Or are you going to get Burns Powell? Or are you going to get a mix of the two? And he is going to be grilled hard. It is going to be probably the highest rated Fed press conference ever in history. I mean, they should be selling 30-second spots, advertising spots for like $1 million. It'll probably be more watched than the Super Bowl. Actually, that's probably a lie. For people like us, it's a not miss. No one's going to miss it, but for the vast majority of people, they probably don't even know that this is going on. Okay, real rates. Again, big moves here, especially on the 5-year, down 28 basis points. And the lower real rates go, the more supportive it is of equities. And even with the week that we had, we do see that the SPY was able to eke out a gain, up 1.08%. And the lower real rates go, if you have cash flows that are further out, it is even a bigger benefit for you. So we would expect to see a tech index up higher, and NASDAQ was up some 4% week over week. In the face of all of this, markets inched up. They inched up, although Friday wasn't a great day. I think most of that gain came from Thursday. Thursday was just this big rally on the idea that everything was going to be solved. And when we woke up Friday, we found that nope, we're still selling these banks that 30 billion was going into. That was the deal, right? 30 billion going into these banks, like, oh, okay, everything is finally over. The banks are bailing themselves out. The banks are helping themselves out. And then that's, quickly disappeared on Friday. Friday was Credit Suisse. And I think it started in the morning with the Saudi, main Saudi commentator, I forget his name, saying that under no condition would they increase their stake in Credit Suisse. And it was because of the regulatory constraints that they would hit if they went over 10%. Suddenly it was just a different investment, became a different investment altogether. They had no appetite for that. So there was this talk of UBS stepping in. And somebody had asked, would you buy Credit Suisse at this point? And it's like, well, no. I mean, it's a wounded player at this point. If they are going to sell, they're not going to sell for any premium above their share price. And we're seeing that. I think this morning, the last I saw was UBS offered $1 billion for Credit Suisse, which ended Friday with a market cap of $8 billion. So they're offering $1 billion for a company that has a market cap of $8 billion. You're not going to pay a lot for a wounded player, right? You're just not. You're going to look at it and say, if I had to take it, what price am I going to take it at? It's got to be a really great deal for me, but I'm certainly not paying a premium. I mean, that's off the table. So I would not be buying shares of any bank on any rumor that another bank might be buying them. In this environment, any bank that's going to be sold will be sold for $1, will be sold for almost nothing. The shareholder is not even going to be consulted. And I think on the story that I read about the offer is that the Swiss government wants this done before markets open on Sunday night, which would be Asian markets in the morning, and they're waiving the shareholder vote. They're saying no, you don't need the shareholder vote. If we can get this deal done, that's it. So they're brokering the deal without the shareholder voting on this at all. And if they do get a deal, that $8 billion market cap goes to $1 billion on the open. Or even less than 1 billion, and that's it. There's no recovery from that because it's done. It's done. All you can do is just sell your shares and be done with it. So let's get back to this. Yeah, so real rates are down and inflation expectations are down. That might seem curious. Why are inflation expectations down if we think the Fed is going to have to cut rates? Isn't inflation going to get worse? Nothing solves a recession. Nothing solves inflation like a recession. Everything that's going on now is because the anticipation of a recession and the probability of a recession just increased. It's not as if they're saying the Fed's going to cut rates because they can't raise rates in this environment. They're saying the Fed is going to cut rates because we're going to have a recession. Inflation's going to melt away to nothing because that's what recessions do. They get rid of inflation. So these are all consistent with a strong belief in a recession. Look at Fed funds futures. When I took the chart out and I started measuring, it was just wow. I mean, I saw the moves all week long, and they were just big moves in here. Last week, the index was bottoming out at July at 94.72, implying a rate of 5. This is 1 week, by the way, implying a rate of 5.28 or a target range of 5 to 5.5. Well, since out of July, we're now down in May, so it's 2 months earlier and 50 basis points lower. It is 95.215, implying a rate of 4.785, which is kind of where we are right now. So the market is kind of thinking that we're pretty much going to stay where we are, and then it just really increases after that. So you can think that somewhere in here you're going to have a Fed that has to cut because of a recession. When we get to December last week, this is a big move here. Last week 95.035 was the index, a rate of almost 5%, 4.965. It is 96.125. Look at the rate, 3.875. That's a drop of 109 basis points on the Fed Fund futures for December. Isn't that wild? 109. That's a policy range of 3.75 to 4, which is 75 basis points lower from the current target. So that everywhere I look, the market is basically saying rates are going lower. Rates are going lower. Whether the Fed wants them to or not, inflation doesn't matter anymore. It's recession. Recession is what matters. They can't go any higher. The 1 year forward minus the current 1 year, negative 110 basis points. Last week it was negative 60. And December 24 to December 23, the rate over the year, 3.84 versus 3.06. I think I got that backwards. 3.4. There we go. I think I got that backwards. 384 to 306, a drop of 78 basis points over 2024 versus 134. The market was saying, well, no cuts in 2023. They'll come in 2024. But now they're saying, no, they'll come in 2023. So we won't need that many in 2024. Last week was 486 to 352. So this 486, this is using 1 month SOFR. So if you go out to December of 2023, 1 month SOFR is now 384. Last week it was 486. And if you go to December 23 on the forward curve for 1 month SOFR, it's now 306. Last week was 352. So it is the 1 month. So just for December 23 is consistent with what the Fed funds futures is doing up here, which it should be. 486 down to 384, 102 basis points lower. This is 109 basis points lower. TLT, lots of volatility in TLT, up 1.63% on the week. I sold over here, it was at 10:02 in the morning on Tuesday. I sold the April 21 102 puts. I got 202. I sold 60 of them. So I now have the January 110 calls. I have the 115 calls. So short here, long here. So I got a $5 spread. And picked up a buck, so that the worst that I can do is a gain of $6,000. And now I've sold these puts at 202. So the worst that I can now do is 18,000. That is the worst that I can do, because I just can't see how TLT gets below 102 at this point. I can't see how it gets below 102. I think the Fed has a problem, and if they go 25 basis points, I can't see them going to 5.5 or 6. They have broken some things, and now we have to wait to see what breaks because of what broke. Not what else will break with higher rates, but these things broke, and there's usually some kind of cascade effect because these things broke. What breaks next? Because these things broke, not because we go higher. So if we go higher, you have the unknown of, well, what will break next? We also have the unknown of, well, what still has to break from what has been broken. So I don't know that they can go higher. So I just can't see getting below 102 again. Implied volatility nice and high. So that was they were nice premiums because the IVP was very high. 13-week percentile, 97th percentile. Last week was 79th percentile. So calls are probably more expensive to buy at this point in time. Anybody who did buy calls, I think previously, is in the money on these calls at this point. And if we have more trouble at the beginning of the week, yeah, I think TLT could probably push and break the highs for the year, 109, 110, and push upwards there. I have no intention of closing those 102 puts, because even though I think that TLT, if TLT does drop, from where are we now, 106, I do not see it getting to 102 unless the belief of 5.25% come back into the market. I'm just not seeing that. So that is easy money at this point. I may roll them to May and roll them up during the week. So right now I think they're worth $1.10. So they're, they've paid off quite well. I think I've got almost 90 cents out of them, that if I close them, that's another easy 90 cents, but I don't see why I would, because I'm not concerned about the 102 being breached at this point. If I see them at 50 cents, 60 cents, I may close them and roll them into May and roll them up. Roll them up to maybe the 104 or 105. So I may continue to roll up these puts as TLT goes higher. But that's really tactical. You have to sort of read the market and read what's going on and read the tone and think, well, do I think TLT can get back to 104? It touched 104 down here, but it really didn't get much below that. Given the tone that we have, unless this banking crisis sentiment disappears and we think, okay, well, that's all gone, it's in the background, it's like it never happened, and inflation is the only thing we care about now, then yeah, we could. But I just don't see how this goes away this easily. So yeah, if I do close these, it's because I'll be closing April at 102 and rolling over to May maybe at 104, 105, 104, 105. I don't know yet. I got to see how things unfold, but that's the move that I'd be most likely to take, as opposed to just closing out the puts, because I think there might be some pullback in TLT below the 102. Below the 102. Well, this is also the week in which OAS got the memo. All of the spreads have increased. 31 basis point increase in investment grade is a 24% increase in the spread. 123 points on Triple C. So all of them have increased by at least double-digit basis points. The premium that you'll get, the excess return that you'll get above a default risk-free rate is now 132 basis points. We look at the 1-year T-bill pays 4.26. The 1 to 3 year investment grade bucket is at 5.58. So that's a premium of 132 basis points above the 1 year. It was 61 2 weeks ago. So it is moving in the right direction, suggesting that an investor should be paid extra for taking on credit risk. There was a point where you almost got nothing for taking on credit risk. Why would you do it? Mortgage rates, 6.6%, down 13 basis points, but we don't have the benefit of having Friday included in on this. This is as of the end of day Thursday. So we have to compare it with the 10-year Thursday over Thursday, and it was down 14 basis points. The fixed rate mortgage down 13, so the spread increased by 1 basis point. Mortgage apps up 6.5%, but that's for the week ending March 10th. The week ending March 17th will be far more interesting because you will have the full effect of the SVB, Signature Bank, Silvergate. You'll have the full effect of that in there. We'll see if it has any effect on mortgage applications. Both refi and purchase were up. So when we look at this, when we look at some of the housing stuff here, NA and the National Association of Home Builders, the housing index for March came in at 44 versus 42 for February. Building permits in February were up. Housing starts in February were up. You've got a very robust market here. That the backdrop is promising. It would be at this point the question: does what happened in the banking sector affect the momentum that we saw in housing? Well, maybe not momentum, but at least the strength we saw in housing. We can get some clue by looking at the housing stocks over a 1 week period, and this was last week. Lennar up 6.28%, had great earnings. DHI up 3.55%. These are fixed rate mortgage sensitive, so they will respond closely to the level of fixed rate mortgages. Agency dropped 2.31%. Annaly was flat week over week. These are spread sensitive, so these will respond to the change in spread. And MBB, which is an ETF that holds mortgage-backed securities, is rate and spread sensitive. So it is the 10-year plus the spread sensitive. So it kind of gives you three things to look at here. If you're just looking at the fixed rate mortgage, that is more important for home builder stocks. The spread is more important for mortgage REITs. And if you're holding the actual bonds themselves, it is the combination of the 10-year and the spread together. Okay, let's cycle through a number of different charts as indicators. We have the yen on the top panel and we have the peso in the bottom panel. They both start with the US, so the direction of the chart is the direction of the US. We see for the yen, the US dollar weakened, which means the yen strengthened. We see for the peso, the US dollar strengthened, which means the peso weakened. If you're ever confused about real market currency quotes, they're usually given this way. The very first one, the direction of the chart, tells you about what's going on with the first currency. So if you see a chart moving up, that means the US is strengthening. If you see a chart moving down, it means the US is weakening. If it was euro.US, then the direction would be about the euro. So it's just easy to keep in mind. All you have to do is just cut off the quote and say, okay, this is the US dollar. Right? Cut off the second part and say that's the US dollar. Here the US dollar is increasing against what? The peso. Here the US dollar is decreasing against what? The yen. Down 2.355, and this is up 2.2%. So here we have a US weaker, yen stronger, which in times of crisis, in times of fear, when there is a rush to safety, you would expect these safe haven currencies to do well. And the yen outperformed the US. They're both safe haven currencies, so that is kind of bullish for the yen here. Here you have a US dollar stronger, a peso weaker. The peso, as I said before, would not do well in recessions. The yen will do well in recessions. The peso will not do well in recessions. And I had a good time this week. I had a bid at 19, and I covered at 1875. Bought it at 19 again. Covered at 1875. Was going to do it again at 19, but it never got there. So there I am. The Canadian, US CAD, negative 0.72. So again, that is the US getting weaker against a stronger Canadian. Tuesday, if you're doing anything with the Canadian dollar, Tuesday's a big day, Canadian CPI. We in Canada are probably not going to feel much from the banking crisis. We don't have banking crisis in Canada. I don't think we ever have in the almost 150, 200-year history of the big five banks in Canada. Nothing at all. In fact, they're quite resilient only because we have a different banking environment altogether. So we are seeing weakness in Canadian bank stocks, but that weakness, I think, is just a screaming buy opportunity for the Canadian banks because it doesn't have the same effect. I think a lot of the effect of Canadian banks is coming from the fact that they are also listed on the New York Stock Exchange in US dollars. They are in the banking sector, and algorithms are just selling the banking sector. Quant-driven strategies are just selling the banking sector. And since they just happen to be on the NYSE in the banking sector in US dollars, I think they are being sold as a result of that inclusion. Had they not been listed on the New York Stock Exchange and only been listed on the Toronto Stock Exchange, I don't know that they would have the same effect. So if we're looking for risk events for each of these currencies, for the Canadian, Tuesday CPI, for the yen, Thursday you got Japan CPI, and you've got the FOMC because you have two parts of this. And for the peso, the FOMC on Wednesday is the big risk factor here. I really don't know what to expect for the US dollar. It's almost a coin toss. Can I make a case for a stronger US dollar with a rate increase? Yeah, because the rate increased. Can I make a case for a weaker US dollar because of a rate increase? Yeah, because if you increase the rates, you're going to break a whole bunch more and you're going to hit a recession, and rates are going to have to be cut faster and lower. How far ahead does the market look? I don't know. So on this one, I would not be increasing any active positions ahead of this thing. So if the peso gives me a way in, I will take probably a half position of what I normally take ahead of that meeting, and then I'll see what the result is after that. But at this point, the positions I have, I'm just going to hold. I do have some position on the Canadian, but it's mostly a hedging position. I have nothing on the peso except I do have pesos in my account. So I do have an active position in the peso because every time I trade the peso, I actually make pesos in my account. So if I look at my currency balances, I have a significant peso currency balance. So I do have a position. If I want a neutral position, I would just do a currency conversion and convert all of that into my base currency and be done. And I do have a long position on the yen, which sucks because you have negative carry on both sides. You're not getting the US dollar interest rate because you've sold your US and bought yen, and the Bank of Japan extracts 0.1% of your yen on a regular basis. So negative carry on both sides. So I don't mind this working out. I think a fair target based on what I've heard from different speakers, and these are people who were in the Japanese government or in the Bank of Japan previously, are thinking 120 seems to be the target on the yen. And I think if you have a recessionary scenario, the yen could get to 120 rather quickly. In a recessionary scenario, and this is probably where I should exercise some caution on the peso, is in a recessionary situation, the peso can get to a range of 22 to 25 very quickly, depending on what the catalyst of this recession is. If it's another big event, if you get another SVB, You know, like I've said before, you get this event that happens that nobody expected. It comes out of nowhere, and it affects everyone's mindset. If you get another one of these things showing up, that's the end of the game. There is nothing that can be done other than just to backstop absolutely everything, because confidence is already fragile. You get another one that shows up out of somewhere else, the question will be, well, what else don't we know? Everyone's asleep at the wheel. We got to get out. And, you know, all the conspiracy theories will start. All bankers will be called criminals again, and off we go to the races. So the worst thing that could happen if you're expecting stability is for another unknown to show up. Okay, two panels here. Top is a gold futures contract for April, and the bottom is the Bitcoin reference rate futures for March 31st. This one expires March. Gold up 6.46%. These are 1 week. This is 1 week charts in case you're thinking it's longer. That's 6.46% for the week. You had a massive breakout in gold to the upside just on Friday alone. Bitcoin reference rate 1 week, 34% increase in the price of the reference rate. And if we look at money market funds, for this is March 16th, and this is for the end of date March 15th, and this is a week over week. Total money market assets increased 120.93 billion to a total of 5 trillion for the week ending March 15th. This does not give us Friday. This does not give us the effect. If that happened in gold and this is happening in Bitcoin, you went from under 25,000 to almost 27,000 in 1 day just on Friday. If this is happening, this is money running to stuff. Well, we don't have the benefit of seeing that in the money market funds because this is only the 15th, so how much more was it? It breaks breaks it down into a retail and institutional. The link for this is in the description box below if you want the full link to the release of this. This is done weekly. Retail increased by 20.15 billion. Institutional increased by 100.78 billion. And again, we don't have Thursday and Friday. And as I said with the Treasury curve, when you see this much money rush into these places, that's not just for 5 or 10 minutes. It's not as if they're going to say Monday morning, oh, okay, everything's fine, let's go back. It's not as if all this money's just going to flow right back right away. This money's on vacation for a while. You know, it's got an Airbnb for the next couple of months, and that's where it's going to hang out. So it's not coming back on Monday or Tuesday. And it'd be interesting to see how the week plays out. You've got a big event, huge event on Wednesday, and I don't know that there's much going on in the market until that day. But then again, it's so hard to tell right now because there's just so many balls in the air and that are significant. You know, you got the Credit Suisse issue. How's the market going to see that? You know, you still have questions about the recapitalization of the banks for the regional banks at 30 billion didn't seem to help on Friday. Is that going to continue on? I don't know that I've ever been so sort of uncertain as to what will happen, but absolutely certain what the outcome will be, which is recession. I'm more convinced now than ever that is an inevitability at this point. But if you ask me what the weather is going to be like on Monday, not a freaking clue. Not a clue. I have no idea. So carry an umbrella. It's the safest thing I can say. So listen, these are destinations. Whenever there's fear, you have to look at two things. You have to say, well, where are people running to and what are they running from? So we know they're running to what are considered safe assets. They're running into the yen. They're running away from the peso. They're running into the Treasury curve. We saw that. They're running in there massively. They're running away from corporate because we saw spreads widen. They're running into alternatives like gold and Bitcoin for those who say, oh no, it's a lot worse than what you think. Money's going to be worthless. We got to get gold. We got to get Bitcoin. So it's running into those things. Is it running away from another 25 basis point increase? Maybe another 50 basis point increase until we're done? Or is it running away from a collapse of the banking sector and an absolute recession. With this kind of fear, with these kind of movements, we can infer that what they're running away from can't just be 25 basis points. They're not running away from a Chihuahua. They're running away from a rabid Rottweiler here. Okay, let's see where else money is running away from. Copper and oil, and we're going to look at two benchmarks for oil. We'll look at West Texas and Brent. Copper down 2.8% for the week. CL, West Texas, down 13.48% for the week. Brent down 11.83% for the week. Whenever you're setting up screens to be able to watch something, you should always have the two benchmarks for oil, because they're a barometer of the global level of growth and what the forecast for growth is going to be. And these are down huge. This is not running away from a Fed hike. This is not what this is. This is bigger than that. These are all very, very tight, aren't they? Freeport down 4.31, BHP down 4.34, Rio down 4.25. Freeport is elevated now to my favorite of the three. BHP probably my less favorite of the three, because a big class action lawsuit has reopened up, and they could be potentially. Listen, companies are being sued all the time. Every company has some legal action against it at all times going on, right? Because they're targets. But just for conservative reasons, if I had to pick something to be in, it would be Freeport over BHP at this point. But all down in a very tight range. They sort of all trade as proxies of each other. West Texas down 13.48. If you have the extras series, I had laid out a trade, a pairs trade for oil and gas. If we look at gasoline, RBOB down 5.67% for the week. If you look at what CL is doing, so if you did the trade long gasoline, short CL, and you were dollar neutral, last week was a beautiful week, a payoff on that particular trade. I think that continues to pay off. Although I'd be careful about a rebound, because if there's a rebound, oil will definitely outperform gasoline on the way up. But whenever you do a pairs trade, it's not day by day by day. You expect it to outperform. It's over some long period of time. You'd expect one to outperform the other. Interesting here, if we look at Occidental Petroleum, it was down 2.48%. But during the week, and it gives you the dates here, this I got from Interactive Brokers for Oxy inside purchases. Berkshire is considered an insider because of their sheer size. From the 13th to the 15th, which means the week that just was, another almost 8 million shares were bought for almost 60 million more. Now owns 23.1%. 7.9 million, we already did 7.9 million shares, so we can ignore that. Now owns 208 million shares, total value 11.8 billion. So is just buying every single week, is out there buying. So I have bought shares directly, and I've sold some puts on this as well. Barclays on March 17th put an overweight on Oxy, price target $78, and they're 58.59 right now. Brent down 11.83%, sitting at low 70s, below 70 from what I understand, listening to different energy analysts. Below 70 is a very critical level, that if it breaks down below 70, that is a vote on the market against global growth, and there is more and more sentiment brewing that China is not going to be the growth engine out of this problem, that the reopening of China was way overblown in terms of the potential that it's going to have, and we're seeing that in copper, and you're seeing that in Brent. So we should look at the CPI report last week, because, well, that's what the Fed is in the fight with, is with inflation. I mean, we got a lot of stuff going on. The market is clear that it is expecting the Fed not to hike and to actually cut rates quite significantly into the end of the year. But let's just see what's going on with the fight. So here we have sticky price CPI. We're not going to look at the CPI report because if we look at this chart, they already have updated this for February, so we can see it visually here. And we do want to get to the core components anyways, right? If we look at this is right now, this is showing 12-month sticky CPI, the orange line, and 12-month flexible CPI, which is the brown line. You can really see flexible coming down, but the sticky component, if we look at for February here, sticky CPI 12-month 6.7%, flexible 4.9%. But that's year over year. Let's see if we can do a little bit better than that. Let's go to sticky 3-month, and we'll get rid of the 12-month. We'll look at core sticky at 3-month, and we'll look at flexible 3-month and core flexible. And we'll just hover over the final point here and look at what we have. Sticky CPI. If you take the 3-month sticky CPI and annualize it, it's 6.5%. The core sticky CPI, the first one is all of CPI. The next one is core sticky CPI, 3-month annualized, 6.5%. Flexible 3-month annualized 0.1%, and core flexible negative 0.4%. The Fed's point is that the deflation that you've seen in the lower two, the flexible components, the base effects will wear off so that the contribution it has made to lowering CPI will be negated, and all you'll be left with is that core. And if you take the 3-month and you annualize it, it's still at 6.5%. I don't see them pivoting to a pause or a rate cut, being that the fight hasn't been won. I don't see them doing that. I think what they're more likely, the logic they're more likely to follow is as follows. That's a terrible sentence, right? The word follow in there twice. Just please ignore that I did that. I don't want to see any reports of that on Reddit that you won't believe the grammar he used. I'll deny it. I think this is the logic is that, look, the banking crisis that you saw was idiosyncratic. There were, in that industry, of which you have thousands of banks, there were a number of banks that weren't doing their job. And there were, let's focus on the 99 point how many percent that were doing their job. These guys weren't. So you can't blame the entire environment just because you saw these few that failed. And listen, we've provided liquidity. We've backstopped liquidity for every bank. This was a liquidity problem that they themselves created, that they had through their own mismanagement. If there had not been a run on Silicon Valley Bank on Thursday afternoon, if depositors had not run to take their money out, we wouldn't be talking about this. It was not the rate hikes that did this. It was not the held to maturity that did this. It was the loss of confidence of the depositors that did this. Really, that's what it was, because had that not happened, let's say all the mistakes were made, but that nobody ran to take their money out of the bank, none of this would have happened. None of this would have happened. But the conditions were right for that loss of confidence. So you could say, well, they were responsible for creating the conditions for the loss of confidence, but it was really the loss of confidence and the reaction to that that really started this whole thing. Well, we've taken care of that, okay? All the depositors are going to get their money back, and we've opened up the window now for all banks to pledge collateral at par. That takes care of the held to maturity issue for the liquidity crisis. We've taken care of that. We're good. Think about it this way. Let's look at the ocean, and you have thousands of ships crossing the ocean at any given time. Some of them are crossing the ocean when, in calm waters. Some are in more treacherous waters. As the further away you get from the equator, the more treacherous they become. If you're in the North Sea in October, well, you need a good crew. If you're crossing the Pacific in June and you're using the major current to cross, well, you're going to do okay. I mean, the current pretty much carries you across the water, right? It is not incumbent upon the ocean to manage risk for all those ships. We would not demand that the ocean manage those risks. So if a ship gets into trouble, we would not blame the ocean. You have to blame the crew of that particular ship. Well, all organizations operate on an ocean called the economy. That's the environment. And every organization has a crew responsible for navigating that environment. There are going to be some ships that run into trouble. But we don't blame the ocean for that. You blame the crew. If we look at SVB, if you look at all of these particular banks, you can find issues particular to that bank that in a situation or an environment like this, given the characteristics that they had, there was going to be an issue. I mean, looking back, it's easy to do, but when you're doing the autopsy, you can see exactly what the cause of death was. That's the point of it. You can see, well, this is what led to it. To suggest that the environment was at fault, to suggest that the rate hiking cycle of the Fed was at fault, is to blame the ocean for a poor crew. There is, in the environment, inflationary potential, and inflation did show up. Well, that's like big waves on the ocean. Well, we know that a Federal Reserve exists, and one of their mandates is to fight inflation, and we know they do that by raising rates. This was well telegraphed. We knew this in advance. The pace of the increases started to come as a surprise, but from meeting to meeting, you did have you had the benefit of some kind of visibility. That if you are on the ocean and you start seeing the waves rising and you say, full speed ahead, nothing, we don't need to change anything, don't worry, why don't we take a break and let's head down to the mess hall, put the ship on autopilot, if there is such a thing. Well, if you're not going to manage a changing environment, if you're not going to maneuver with a changing environment and do more of the same, that's an idiosyncratic issue. That's not an environmental issue. So I think the Fed may be thinking that, look, these were idiosyncratic issues, but just for the sake of saying that we've done something, we've calmed the ocean. We've done the impossible. We've calmed the ocean for every ship navigating the ocean. There you go. Let's get back to the business. And the business is right here on this screen. Core sticky CPI, 3-month annualized 6.5%. The job is not done. And they've said many times, if we pause, if we hold, it's only going to make things worse. A recession is not in the cards, is not in the books, and they're not going to admit that. So what is going to be interesting on Wednesday is not just the rate decision. I think 25 is probably going to happen. Two other things. The summary of economic projections. Have they lowered their expectations for growth? Have they raised their expectations for unemployment? And does the dot plot decrease? That's going to be huge. And then the press conference, which is a combination ballet and train wreck when it comes to Powell. Okay, get to the main event here. I call it the main event because YouTube gives me statistics on viewer engagement when I look at the market outlooks to see where people are viewing. This is the most viewed segment of the video. So I think that some people, when they start watching, just click on the timeline and come right to this, and they're mostly interested in what's going on here. And I would say if you're one of those people who skip all the previous stuff, that's important to know why I say what I say here. All of that stuff is important. So I don't know that skipping it does much for you. I think you get a lot more out of it if you watched through it. You don't have to agree with me, but at least at that point you know what I'm looking at and you know why I came to the conclusions I came to here. Forward 4-quarter earnings, 219.39 versus 219.46, down 7 cents. The week before it was up a little bit. Basically flat for the last 3 weeks. I don't think that it is being updated with new forecasts just yet. Hard to have visibility with the volatility in just sentiment that is going on. But let's just take the financial sector. Earnings are going to have to come down. You have a significant number of banks that have used the new Fed window because we saw the balance sheet increase dramatically. Well, that money is at 5.5%. Well, that wasn't in the forecasts before. The cost of that money wasn't in the forecast, so it's going to have to come down. And you can just do a little thought experiment here. Given what has happened, what we've seen in the banking sector, do you think this will make banks more or less willing to lend, right? We don't have to forecast very much. I think we could say, well, it's probably going to make them less willing to lend. They're probably going to raise their standards for granting credit. So fewer newer loans. Do you also think that this will make their loan loss provisions increase or decrease? If you say increase, well then lower loans, higher increase, and higher costs, earnings have to come down in the financial sector. So this 219.39, I expect over the next 3, 4, 5 weeks to drop quite considerably. Closing SPX 39.1647 puts you still almost at 18 times forward earnings, 17.85. That is a 5.6% earnings yield. The 6 month is at 4.71. The 1 to 3 year IG is at 5.58. So it's almost saying, on a yield basis, fairly consistent. Is it fairly equal? But there is an opening up between the 6 month and the market itself. It's not so close that you could say, well, I can get 4.71 for sure in 6 months, but 5.6 as the middle of a distribution. Okay, that doesn't mean you're going to get that yield. That yield is the middle of a distribution. 4.71 is a point estimate. There is no distribution around that 4.71. 5.6, which is over here, is the middle of a distribution. Right? It's the middle of a distribution. Sure, you can do better, but you can do worse. In fact, I would say at this point, the distribution is probably more skewed to the left. If I had to pick probabilities, I'd say it's probably more skewed to the left. So is it worth the extra 90 basis points to take on this distribution with what I believe is potentially a significant left tail risk? You have to ask, right? June ES closed at 39.47. I sold June ES at 39.80. Remember last week I said I closed 5% of my short position, and I sold some puts and closed some calls. Well, on the rally on this was early Friday morning before things started to really fall apart. I got 39.80 on the short. I added back my 5%, and I sold $4,000 calls. I got a premium of 180 on each of these calls. I sold a lot. I said I didn't think that I would get another chance at these levels, so I just said I'm not going to take a little bit of 10% or 20% of what I want. Let's just do 100% position. I sold a lot, so I added back all the calls and then more. On the rally, it did allow me to close the 3,600 puts, the $3,700 puts, and I closed the SPY 380 puts. So over the course of the week, I raised my duration because remember I sold the 102 puts. Well, puts have negative duration, so if you're selling negative puts, you're adding duration, right? So I raised my delta exposure on duration, and I lowered my beta. My beta was already negative. I added more negative beta. I sold the calls which have positive exposure, so I get negative exposure here. And I sold calls, which also gives me negative exposure here. And I did this significantly. And for my delta, depending on how the market plays out, I will continually roll up the puts. I can do quite well rolling up the puts, so I'm not too concerned there. I bought ABR as well, and I sold puts on ABR. That report that was put out was basically just a fraudulent report. It had all the earmarkers of a fraudulent report as well. And I had been through that video. Whenever you're trying, just as a lesson, having created two religions in the past, one of them working out well and one of them not working out well at all. That one went really bad. But when you're doing something like this, what you want to do is you need markers of truth. You need truth. Any conspiracy theory, by the way, if you want to weave a conspiracy theory, let's get 5 different markers of truth. There, that's all you need. And now you weave your story in between these markers of truth. And the more complex the story is, the harder it is to follow, the better it is, because no one's going to put in the work to follow the threads, but they will say, this is true, this is true, this is true. You have some markers of truth in there, and that's all you need. That's all you need, and make everything extremely complex on purpose and have those markers of truth. There's your conspiracy. And you'll get people who will buy into it because they'll say, well, this is true. I mean, that's fact. That's a fact. That's a fact. And if you can get them to agree on some parts of it, because of the laziness of most people, they will take the whole thing in. They will buy the whole thing because some aspects of it are true. That's what that report was. So I bought ABR, I sold puts, and if you were watching ABR last week, they got an upgrade. It wasn't an upgrade. It was a restatement of a price target, 1750 with an overweight. I forget who gave them I think it was Raymond James. And late Friday, after 5 o'clock, ABR made an announcement that they are going to buy back $50 million worth of stock. So they got a $50 million, is it 50 million or, yeah, no, sorry, 50 million share buyback. The short interest is probably a result of this company here, and that buyback is particularly targeted to punish them. So they are probably going to initiate a short squeeze on these short sellers, which I believe are scammers. So I bought ABR, I sold puts. It was easy to refute that article with one simple observation, is that if all the accounts are fake and the escrow is fake and the cash is fake, how is it possible over all those years to get those payouts in the dividends? If you look at what they pay out in dividends, earnings of $2.30 a share, they pay out $2 in dividends. You got to come up with cash. You can't make up cash. Oh, you can make up earnings, but you can't make up cash. You either have cash or you don't. Done deal. Period. Finished. So I didn't need to refute the contents of that report. It was just false on the front of it. Here's a good analogy for why I don't have to refute any of the points that they made. I get phone calls at least every couple of months from Revenue Canada, with an Indian accent telling me that an arrest warrant has been issued for my arrest and that I owe this much in tax. And lo and behold, lucky for me, Revenue Canada now takes iTunes cards. So I just have to go out and buy a whole bunch of iTunes cards and give them the code, and I won't go to jail. Would I take a single second to say, well, hang on a second, let me refute the point that I owe you tax? Would I even stop for a moment to say, let me attack this on the points that you're making? I owe tax? How much tax do I? What year is it for? Well, what did you disqualify? Would I even spend a second investigating that? No, because it's false on the face of it. Why would I invest a minute of time on the merit of any argument they have when it's false on the face of it, right? That's the same thing with this ABR thing. I sold puts on Ford. I sold puts on Stellantis, and I sold puts on Oxy. I also added to Freeport, BHP, and Rio, and I bought more agency. Because I'm taking a bigger negative beta position over here at the micro level, I want to add positive positions so that if I am wrong on my short beta, my underlying positions here pay off while I lose on the other one. But if I'm right, I want all of these anyways. This is for the next business cycle. I want all those anyways, so I don't mind seeding those fields now. I want all of those anyways, and the gain that I make from my short beta will more than pay for the positions I have here. In essence, the market is giving me these for free if I'm right. IVP, now's a nice time to be in the options for sure, right? IVP 13-week 97%. 97th percentile. It's going to be hard to get to the 100th percentile because you really got to spike implied volatility. 26-week is 65% from 62. A 19-day at the money straddle is 4.26%. You'll recall About a month and a half ago, 2 months ago, that was sitting around 2.8, 2.9%, 3%. Well, now it's 4.26%. If we're looking at a fair value, equilibrium fair value for the market, equilibrium multiple 16.6. That's based on current earnings, which I think are overstated. That's 36.41. An expected return, long-term expected return of 11%. That's a total return. Your dividend yield will give 1.8% roughly, so you'll get about a 9.2% price return. 289 days left to the end of the year out of 365. Multiply your 360, 36.41. You get the 39.07 as a year-end equilibrium target. Equilibrium is a theoretical place. It's kind of like a perfect form. That in a perfect world, you would have a perfect price because everything would be in equilibrium. Now, you may say, oh, but we don't have a perfect world. Let's throw that away. Perfect forms don't exist in the world. They don't exist. But what perfect forms do is they create a North Star. It may be difficult to determine where you are at any point in time, but if you have a compass, you can always tell where you are relative to the North Pole. Even though you can't say exactly where you are, you have a relative position, and that helps you. So the perfect form gives you a relative position. So we can look at 39.07. We could say, okay, that's a year-end equilibrium. Do we think that we are in the conditions that justify an above equilibrium price or a below equilibrium price? And we start from that relative position that, okay, in equilibrium, we have a return of 11%. We have this long-term return of 11%. That's sort of an equilibrium trend with a multiple of 16.6 based on earnings. Are we in conditions right now that say, oh, I think we're above equilibrium? With everything going on, yeah, we're in above equilibrium conditions, because if this is a long-term equilibrium, remember markets do this, right? They do that kind of stuff. So at any point in time, you're either above or below equilibrium, with equilibrium being sort of an attractor point. Are we in conditions that justify an above equilibrium price on the market, or are we conditions that justify a below equilibrium price? If we think we're in conditions that say, well, given everything that's going on, this is below an equilibrium environment, well, then your year-end target would have to be lower than 39.07. So we can sort of get a location for price based on our deviation from a perfect form. A perfect form here being equilibrium, right? So, you know, there's been a lot of criticism about the use of the normal distribution as for modeling returns in a market. Well, the point is not to use the normal distribution. The normal distribution is your perfect form. It's your North Star. What is more important is where you are relative to the North Star. You look at your deviations from normality. And that gives you an idea of, well, do we think that where we are justifies that deviation from the perfect form? Should the deviation be more or less? So we can then look at it relative to a perfect form. So if you're wondering, well, why do we use such a theoretical construct as an equilibrium, is because it gives us at least a relative position in an otherwise complex system that would be difficult to work with. For those of you who have been through level 2 corporate finance, who have visited the Modigliani-Miller theory in determining the effect of capital structure on the value of the firm, you will understand the idea of the perfect form and deviations from the perfect form. Put call ratio for Friday, 1.15. Open interest, 2.15. Last week, open interest was 1.97. So there's a lot more interest in puts. Which makes a lot of sense because you have implied volatility at 97%. You have extreme skew. When you have extreme skew, put calls are super cheap. Put spreads are really cheap to buy. So if you're buying a bear put spread, because you have increased skew and this heightened volatility, they become really cheap to buy relative to a perfect form. Relative to what you would pay for a perfect form, they become really, really cheap. The bull call spreads become very, very expensive. risk reversals become attractive at this point, but I don't think that this is the place for a risk reversal. You need a significant pullback for a risk reversal, which means you need a real spike in volatility before you do a risk reversal. And we're only at 22.3. That was the last implied volatility. If you look at these peaks back here, this peak over here, I know you can't see it very well, but you'd have to be upward somewhere around 28% here before you'd start considering a risk reversal in SPY. Last week was 21.7, so we are moving towards there. That is it for this analysis here. Just as a big summary, I really took my short position on the market. I have added to my June short position on ES. I have some nice negative, some nice positive carry there because futures have negative carry. And I sold calls at 4,000, which by the close of Friday, both of those trades were in the money, but I have no intention on closing these at this point. I'm just going to let them run. Where would I think about closing these? I've thought about that because I like to have a trade plan in mind at what level I would like to close these. I don't know that I have at this point. It's going to be day by day. But I do think that we are in for some significant downside from here based on how much money is running away from risky assets and where they're running to. So we do see money running, although it hasn't really shown up in the equity market that much yet. I think the equity market has been the slowpoke this whole time. I think earnings are not reflective of what everyone else, if you go to fixed income and in the energy market, in copper and gold and Bitcoin, if you look at what's going on there, I think they're all voting that that is probably aggressive. And I think there's an agreement that that is probably aggressive as well, that if you get back to a 16.6 and this heads down to let's say a 200, towards a 200 at 16.6 is 33.20 at that point. So even if you say, well, what if it just goes to 210, you're 3,500, which is down here. So which is revisiting the lows of October, which, you've heard that being mentioned, I think, quite a bit from different analysts, that we think we could revisit the lows of October at 3,500. I don't think that that's an unrealistic statement to make. I think that there's a significant probability that is in the cards at this point. So when am I going to close those positions? I do not know, but I will not be as eager to sell puts on a sell-off this time as I was last time. No point looking at the calendar ahead this week. There is only one date on the calendar. There is only one date, and that is the afternoon of Wednesday. I know the caterers and the band will be here in the morning setting up, and the party starts at 2 o'clock. The summary of economic projections are going to be important, but resist the urge to trade the market on that, because we all know the main event is 2:30. And then there's lots of directional changes during that period of time. And then, well, what happens after that? And then it's, well, does that carry over to the next day? So I think there is only one story this week, big, fat story, and that's the Fed. And I think that's all that's going to matter at this point. Anyways, be safe out there.